So at this point, I'd like to turn it over to Adam to give you a little bit more insight as to what's going on. Adam?
Thank you.
Oh, thank you.
Okay, we're going to take you through some sales and rent data just to kind of back up our outlook, and we'll take a slight detour in there to help explain why some of these prices have risen so high over the last 10 years. So we're going to start off with total sales, and these numbers all are for 5+ units, so no fourplexes or duplexes, any of that. Most recent high water mark as far as total sales was in 2015 with 75. Last year we had 50, which is a bit over the 10-year average here and quite a bit better than 2009 when we had 19. This next slide is sales volume, and you'll notice it doesn't quite match up with the total sales. We had peak total sales in 2015, but peak sales volume in 2017, $657 million. And a bit of a drop off last year, just under $600 million, but still 12 times what we had in 2010, so not much to complain about there. I actually thought it was going to be a lot less, but we had a huge fourth quarter with over $280 million in sales. So almost half of last year's total came in the fourth quarter. And it's normal in a market this size to have large swings from quarter to quarter, and a lot of that's influenced by the mega sales, the big newer properties that we like to call whales. We'll talk a little bit more about that. Sales price per unit is kind of a way to compare properties of different sizes, more of an apples to apples comparison. The average price per unit in 2010 was $40,000 per unit. Last year it was $140,000, so quite a big change there. But once again, a small drop off from 2017. So what's going on there? Why the drop off? We noticed a bit of a disconnect last year between sellers and buyers. Sellers had seen prices rise and rise and rise, and they expected it to continue forever and ever and ever, which obviously does not happen in the real world. And we noticed buyers and banks getting noticeably more conservative in their underwriting, paying more attention to actual numbers versus projected numbers. And so a bit of a disconnect there, which we think is working itself out now, and it is probably a good thing for the long-term stability of the market. But speaking of whales, this is the biggest whale of all. Sold last year and set a record in terms of total price and price per unit. The total price, $77.6 million, and per unit, just under $241,000. This is up near Union and Powers, for those of you that don't know.
2 slides ago, I think it was, Adam was going through what the total sales volume has been over the last decade or so. This one sale is half again as much as every single sale in El Paso County in 2010. So the market's been a lot more fun for brokers here for a little while.
And Bruce will tell you a little bit more about this, but I think the median price for a home in El Paso County was definitely over $300,000 last year. So not far off from that. You got to be making a lot of money to charge a price like that, and they have been. So let's talk cap rate. For those of you that don't know, a capitalization rate essentially is what your return would be if you paid cash for a property, so no financing at all. And as the cap rate goes down, value goes up because you're paying more for the same income. So I've got 3 lines there. Blue is Colorado Springs, gray is the national average, and then orange is Denver. You'll notice Denver's a lot lower than Colorado Springs, so prices are higher. Why? It's a bigger market, it's got more robust growth, and more resiliency in a recession. So investors perceive it as lower risk, hence they pay higher prices for it. So in 2009, we had a cap rate of about, on average, 8.8%. Last year, that was 6.1%. Pretty big difference there, and we'll go more into that in the next couple of slides. I just want to point out a couple of trends here. The gap between Denver and Colorado Springs has decreased over the last 10 years. In 2009, it was 1.5%. Last year, it was 1%. So what's the reason for that? I think it's a couple things. Colorado Springs has definitely picked up the last few years as far as economy. Additionally, a lot of investors were coming from higher price markets like Denver, like California, looking for higher yield in a solid market, and the increased competition here has decreased that gap a little bit. So what effect does cap rates have on valuation? We'll do a little example here. Take a property that has a net income of $300,000 per year. And at a cap rate of 8.8%, like in 2009, it would be worth $3.4 million. Not too bad. At a cap rate of 6.1%, like we had last year, $4.9 million. So same property, same income, different cap rates lead to very different valuations. And if this was located on the beach in Los Angeles, it might have a cap rate of 3.5% and be worth $8.5 million. It's totally worth it. There it is. Might explain the high number of investors from California in this market. So that's all at the same income. If you combine that with increasing income over the years from market rent growth, from higher occupancy, value add opportunities, you can start to understand the high appreciation on some of those properties that Stuart mentioned. So back to the data. This is rent per unit. The bars are the average rent per unit, and the orange line is the annual rent growth. And so in 2008, 2009, we had negative rent growth, and it quickly rose over the years to a peak of almost 8% in 2016. That was one of the highest in the nation that year. In 2017, it was 6%, and last year, just under 3%. So what's going on here? Is it just going to keep going downhill until it's negative again in a year or two? We don't think so. Just a couple things to point out. You can't have 8% rent growth year after year after year if wages aren't keeping up, and they have not been. Another thing to point out, that black line is 0%. We're still well in positive territory. And as we'll show later on, we believe the fundamentals will continue to support positive rent growth for the foreseeable future. Occupancy. So at its worst, in the first quarter of 2009, market occupancy was 89%. That was the worst it got. I think that's below what you typically need for like a Fannie Mae loan. But it's gotten better and reached a peak of 95% in 2015 and 16. And it's backed off a little bit since then to 93.5, which is still pretty good. I think the long-term average over the last 20 years is like 92. And that's partially due to new construction. It's due to deployments. Last year we had super gays deployed for the first time in years. I think over 10,000 soldiers, which certainly had an effect. And just an aside, you property managers will like this, but we occasionally hear from owners, typically ones who manage their own properties, say something like, "Oh, I've been at 100% vacancy for 3 years." They're very proud of that. Well, your rents are too low and nobody wants to move. Full vacancy is typically 95, 96% because there's always turnover going on. So market rate properties should not be at 100% vacancy or occupancy. Did I say vacancy? Yeah. Okay. You know what I'm talking
He's
about.
an optimist. It's occupancy.
100% occupancy for 3 years. They should not be at that. All right. So this shows net absorption, how many units are taken off the market or added to in terms of vacant units, and then the number that have been constructed. And this shows quarterly data. It's not the easiest to read, but bottom line, if you added up all the units that have been constructed and all the units that have been absorbed over the last 10 years, we've absorbed more than we've constructed by 1,200 units, or about 2.5% of the overall market. That's data point number one, that we're not overbuilt. Data point number two, each bar shows how many units are being constructed in each quarter, and the orange line shows the percent of the inventory that's under construction. So we're at 4% right now. National average is about 2.5%. So should we be worried? For comparison's sake, here's Denver. They've been over 4% for over 6 years. And there's some debate whether Denver is overbuilt or not. Yardi, which is a property management software company, seems to think they are. But I think you'd be hard-pressed to make the same argument for Colorado Springs. And it's only going to get harder to construct. Rent growth is down. Like Caleb said, construction costs are going up. The length of time it takes to construct is going up. So some of the projects that are in the pipeline just aren't going to pencil out. All right, and then getting into more market fundamentals, this shows the number of households and non-farm employment in El Paso County, and then the rate of growth is those lines. And just to sum it up for you, over the last 10 years, household growth has averaged 1.8% per year. Employment has averaged 2.4% per year. And this isn't the economic forum, so we can't go into all the details of that, but by all accounts, it's not going to slow down anytime soon. This last slide shows, in blue is the single-family permits per year, and orange is the number of multifamily units constructed each year. And the line is how many households we've added to the county every year. We're clearly not keeping up. There's a big deficit there, which is only going to put more upward pressure on rents and occupancy for apartments. So just to sum up how investors see the market, we've got great household growth that's outpaced the new supply coming on the market. We've had very solid employment growth, diversification, especially in healthcare, professional services, and construction, even though it's not enough. And we've got a couple reportedly big employment announcements coming soon. We're in a landlord-friendly state with low property taxes, and we've gotten a lot of national attention recently. So a lot of things to like about the market. A couple of things we're worried about. I'm going to hand it back over to Stuart for that portion. Thank you.
Yeah, there are two things I wanted to go over here before